In this video, we'll take a look at how to read and analyze a candlestick. If you're going to use candlestick charts to profit, obviously you need to know how to read candlesticks. Now, most of you would be familiar with a chart like this, simple line chart. It just simply plots a dot at the closing price, in this case every 4 hours, and then connects them for a line. You can see price has been falling. But with candlesticks, you can see much more information, because it shows you specifically every 4 hours what had happened. It shows you the sentiment of the market, the momentum of the market, the things that truly move the market. Candlesticks harken back to the Japanese rice futures markets a couple centuries ago, 300 or 400 off the top of my head. So it's been around for a while. It's just recent that the West has picked up on it, though. They do come in a multitude of colors, but typically you're going to see red and green, being red being negative, green being positive, or black and white, black being negative, white being positive. So you can see each one of these candlesticks has little bits and pieces that make up the candlestick itself. So I'll go ahead and give you an idea as to what we're looking at here. You have what is known as the body. This is the colored part. And then you have wicks, hence the name candlestick, because it looks like a candlestick with the wicks sticking out. So how do you read this? Well, the first thing that you need to know is the color matters. If there is a color to it, green or red, then it tells you that the market either rose or fell during that time frame. So if this is a 4-hour candle and this body is green, that means it went higher during that 4 hours. The one difference might be sometimes on charting platforms you'll see like a black candlestick if it's a completely unchanged candle, for example. But at this point, let's assume that the body is green. So the highs and lows are the wicks. So you can see that the low was here and the high was there. And again, we know this because this body is going to be green. And I'll go ahead and color that in with my screenwriting tool here. So that's a green body. That's a positive candle. So what does the body itself mean? Well, besides the fact that we have gone higher, the body shows the opening and closing price. Well, if it went higher, then obviously the bottom of the body was where we opened and the top is where we close. So think of it this way. We opened here, we fell a bit, we rallied all the way up here and then closed up here. We closed higher than we started. Now let's go ahead and draw out another candlestick. This time, I will make it a negative candlestick. So this is going to be red. The body is red. We have opened up higher than we closed. So at this point, I'll go ahead and put some wicks on. And you can see that that's the low, that's the high, that's the entry, and that's the exit. The exit's lower. So this gives you an idea as to what's going on during that 4 hours. Another thing that I would point out is the size of the body matters. And why does that matter? Because it shows the distance from open to close. It shows true conviction or lack of. So for example, I see a candlestick here that may not look overly exciting, but in hindsight, it truly was. And the reason was because the body was the entirety of the candle. So think about that. That means during this 4 hours, we jumped in here and just went straight up. It wasn't the biggest candle that we've ever printed in the Ripple market, but it certainly was positive. So was this one. You can see that the high was just above. There is no wick here. We never dropped below that. So the size of the body truly matters. And it works both ways. That's a very negative candle. It's not a 100% thing, but typically if you follow just the impulsive candles, That will get you on the right side of the market. But of course, you can see that we do pull back. I mean, think of it this way. It had you bought Ripple there and you saw this very negative candle with a very long red body, to perhaps be cautious. And that's the sentiment mindset of the candle. Each candle tells a story, or tells a chapter in the overall story that is the market. And that's what we're going to look at in this course. So now that you understand the makeup of a candlestick, we can move further. In this video, we're taking a look at using support and resistance with candlesticks. As you can see, I have the Walmart chart opened again, and I'm going to show you a couple different examples here of support and resistance. Obviously, there's support here. The market just simply wouldn't break down below this area. So, obviously, you want to be a buyer in this general vicinity until shown otherwise. Now, how to use candlesticks in conjunction with this? Well, there's a lot of different ways. You can simply just play the support and resistance and not wait for the candlestick. But another thing that you can do instead is perhaps look for signs that the market is trying to turn around. So we're falling into support, and you can see that we bounced rather hard. The sellers couldn't keep up the downward pressure. And that was your first sign that you would bounce. This is actually a candlestick called a hammer. You can see this very neutral candlestick. They tried to break it down, and at the same spot found that they couldn't. We broke above that range, and everybody in that candlestick is now losing money. And they have to buy their position back in order to cover their shorts. So a lot of it will come down to simply paying attention to where price can or cannot go and looking for failure to break through that level or long wicks or something like that. Now here's a trend line that you can make out on this chart. And clearly that's a very negative turn of events on heavy volume. So what does that tell you? That tells you that support has been sliced through. Pretty straightforward there. However, along the way, here was another one of those hammers that I just talked about where we broke through but couldn't stay below there. And that, of course, is a good sign. Look at these long wicks right there on this line. That's a good sign as well. You want to see one of two things, really, when you're talking about a support or resistance level. You either want to see a candlestick that just goes right through it and closes on the other side of it. Higher time frames, of course, are more important. Or you want to see a situation where the candlestick tried to break through it but failed. Those are your two tells. Anything in between, like a candlestick closing right at support or resistance, typically is a less reliable signal because you're still talking about a 50-50 proposition. Yes, typically support and resistance holds, but it doesn't always. So with that in mind, let's take a look at some charts here, a couple random charts. Take a look at G here. Let's see if we can find an example of support and resistance. Well, here's one that we had some support here, and we gapped lower and then tried to break above there. You can see that the wick broke above the support line just briefly and then turned around and fell back down. Well, is it a surprise that we fell from there? Well, of course not, because we couldn't break through there to begin with. So a continuation of that weakness would be the default expectation. Let's take a look at Hyatt. And here is a scenario where we had some resistance here. And there's a couple different tells here. This candlestick here shows that they tried to rally and break through it, but they failed and they broke down through it. It's actually a candlestick called a hanging man, which you'll learn about later. There's another one here. And beyond that, there's an extraordinarily bearish candlestick that closed at the bottom of the session, showing just how difficult it is to get above this area. And we have since broken down. So again, this is a matter of, you have to pay attention to the psychology. Does it work 100% of the time? Of course not. but it does give you a leg up on the other traders out there who are simply looking at their, you have to keep in mind that there are a lot of traders out there looking at charts like this and their brokerage platforms. They don't really understand the nuances of price. They just see that it fell a couple times. They didn't get the warning. To them, this chart looks like it could be rebounding. So that's part of what makes candlestick trading so important and so useful when it comes to support and resistance. It's something that those of us who have been trading for a while take for granted. But every once in a while, if you look at the line charts or the area charts, you really see the major problems that a lot of the public faces, quite frankly. There's an area there that showed resistance. Looks like it's zone. It's not necessarily just one line. But you can see that we couldn't break above there. And then we formed a very negative candle and then broke down. And then we formed what is known as a shooting star. The next time we tested it, it's not a huge surprise they couldn't break above there, and then they fell. Support and resistance is going to be the basis of everything you trade. So you need to notice where price won't get above or below, and then start placing your trades based upon that. There's a simple way to look at it. We have an area here, for example, that was support, and it worked several times, but eventually it gives way. And then you realize that below here, you want to be short of this stock. This is an area where there was a lot of buying interest, and it's been absorbed. All those orders have been filled and overwhelmed. So pay attention to this. You're looking for several hits at the same line of price or same area. This was hit 6, 7, 8, 9 times. Well, more than that before. So that tells you just how important this support was. And once $75 gave way, we fell pretty significantly. And you'll just see this time and time again. Quite often, markets are just going from point A to point B. So, here we have support. Now it looks like we may come back down to try to find it. There's resistance there. We'll probably go back up there to try to find that eventually. It's just again and again and again. There's really no big, secret to it. It's just where buyers and sellers are. So JP Morgan, we've had some support here. I suspect there'll be some sellers right up here. There's resistance here, but there was also support there. There's people who, once that broke and it came back, they're willing to get out of their positions to break even to kind of save their accounts a bit. They've been spooked back out of the market. So support resistance is crucial. Make sure you use it in all of your analysis. Pay attention to where the market will or will not go. Once you break through it, that's a sign as well. It's a sign that, one side got overwhelmed. In this case, the buyers got overwhelmed. In this video, I'm going to take a look at how to trade spinning tops, pin bars, and doji patterns. These are all very, very similar candlesticks. The main difference, I'll go ahead and draw them out now, is that a spinning top has longer legs. It's basically a neutral candlestick. A pin bar is more like this, and a doji is shorter. So these all tell different stories. For example, the pin bars show signs of exhaustion in one particular direction. The spinning top shows a wide range in indecision. And the doji shows indecisive trading without a wide range. A lot of times you'll see a doji when there are no driving factors in the market. It's just kind of listless. So the idea is that when you break the range of one of these candlesticks, so for example, in the spinning top, which is named as such because it looks like a spinning top, the child's toy. But when we get a spinning top like this, and you break down through it, that shows that a lot of momentum has shifted. Because if you think about the line chart of that, it's going to look something like that. And if you break the bottom of it, we will have had to have seen a resumption of bearish pressure, or bullish if we break the top of it. So a spinning top is a very interesting signal. The pin bars, and these are called pin bars because they're like Pinocchio bars. They have long noses and they lie. So what this means is, with this candlestick, if you break the bottom of it, it's a sell signal. And the reason is the buyers came in and then they failed. And then the next day or hour or whatever, everybody in that candlestick is losing money. Just like if you have a pin bar in the other direction, it's bullish if we could break the top of it. The Doji is, for my money, a lot less reliable. Typically you want to stay in the trend, but in theory you can trade it in both directions. Out of these candlesticks, the Doji is by far the least reliable though. So let's take a look at a couple of examples. In this trade here, we had a spinning top form because this got kind of long legs there. And once we broke through the bottom of it, we did in fact sell off. You would put your stop loss on the other side of the candlestick and your sell order at the bottom, like once we break through that range. You could even make an argument for a couple of spinning tops in a row. So that's an even more valid signal if you think of it that way. The pin bar, and you'll learn about another candlestick formation called a hammer and a shooting star, very similar. But a pin bar has a very small body. Sometimes it's even completely flat like that. So during this candlestick, people rallied, and then we eventually broke down. Well, everybody in that candlestick is losing money, and you can see it leads to a pullback. You enter on a break at the bottom, you put your stop loss on the other side of the candlestick, and you just simply let it rip. And then finally, a Doji. A Doji, a lot of times you'll see them on shorter time frames. This is somewhat of a Doji. That's a Doji there. Really not a lot of range. And you can see that we did, once we broke below it, we did drift a little bit lower, but it wasn't a very powerful move. So Dojis are typically quick hits, if you will. Now, if you're in an uptrend and you see a Doji break to the upside, then that could be a continuation signal. And that's generally the best way I have found to use them. This Doji here being broken to the upside was a good sign. Showed that resistance got broke. This Doji here, etc. So these are pretty standard and straightforward candles. Here is a pin bar here that broke down. And then, of course, the spinning tops that I had shown you previously. Now, remember, everything in trading means more when it's at support or resistance. So look to your support and resistance levels when trying to ascertain how to take the trade or whether it's something you should be paying attention to. If you're at a good resistance level and you have a spinning top, for example, we break down below the bottom of it, it makes sense to short the market. In this video, we're going to take a look at the hammer and hanging man candlestick patterns. So a hammer has a long wick to the downside, and then we'll have a body that is relatively small, like so. And I'll just fill it in there, but that's basically what a hammer looks like. And the idea is that this is the handle, and that's the mallet part of the hammer. So what does this suggest? It suggests that in a situation where you have that candlestick, that traders tried to rally, they fell, and they came back, and something like that has happened. Well, think about what's going on in the mindset of traders out there. There are sellers that are now losing money, and most certainly will if we break above the top of that candlestick for the hour or the day or whatever it is. In this case, happens to be the hour. So here we have a hammer, and it shows a reversal. Think about what happens. Everybody who is going along with the downtrend in the Swiss franc Japanese yen pair here continues to sell on a break down below support, but it gets turned around, and we ended up forming a hammer. Now, there are several hammers here, and that's not that uncommon on short-term charts like the hourly chart, you can see that we're starting to see a lot of support come in. These are 4 different hammers. And with that being the case, it's only a matter of time before we take off to the upside. And so how do you trade that? Well, the easiest way is to let the hammer form and then take a trade about 5 to 10 pips above the top of it, because this ensures that everybody in this candlestick that is short of this market has now the prospect of losing money. So you can see that the next candlestick after the hammer rose slightly, enough to get you into the trade. We pulled back, and then it led the charge much higher. Hammers are very important candlesticks. They're very crucial. You can see here's another example of one. We pulled back, and then we rallied quite nicely. On higher time frames, they do matter more. So a weekly hammer outweighs an hourly hammer. So the hanging man pattern is the exact same candlestick, except for, in this case, the candlestick is at the top of an uptrend, So it shows in this scenario that we're rallying, and then we get into the day, rally a bit more, we pull back, and then we stabilize. And anybody who's long at this point thinks, okay, well, it looks like we're going to go ahead and try to push higher. But once you break down below the bottom of that, this hammer-like candle becomes what is known as a hanging man. It's a very negative sign. It shows that not only have everybody who got involved in this candlestick certain to lose money, that's a sign of serious support being broken, because we've already bounced from there. So you will see these at the top of rallies, and there's actually 2 right there, so that's a really good example. We're obviously in a nice uptrend in the Canadian dollar Japanese yen pair. So once we break down below the first one, technically that's a sell signal, and that is most certainly a sell signal once you've broken down 2 of them. And you can see that we fell almost immediately. Now, it happens time and time again, especially on shorter term charts. You can see that this was a short term sell there as well. But much like the hammer, the key is to trade it after we've broken below the bottom of it. If we break above the top of it, then that's just a continuation of the uptrend. So, in conclusion, a hammer, same candlestick shape, shows a reversal of a downtrend, and a hanging man shows a reversal of an uptrend. Just think of it this way. Support and resistance comes into play in this particular candlestick. That has a lot of support in theory. If it gets turned around and it breaks to the upside, then everybody's losing money at the bottom of a downtrend that got involved that day or that candlestick. If it's at the top of an uptrend, Wraith is feeling good. There's stability there. It looks like we're going to continue. But if we turn around and smash through the back of that, everybody's losing money. And now it suddenly looks not quite as strong as it once was. In the next video, we'll take a look at inverted hammers and shooting stars. In this video, we're taking a look at inverted hammer and shooting star patterns. This is one of my favorite candlestick patterns because it is easy to understand. It has a small body, or perhaps even no body, an unchanged open to close, if you will. It normally has a little bit of a stub underneath, but it doesn't have to. It can not break down at all. And then you've got the long wick to the upside. And the difference between a shooting star and an inverted hammer is simply where it's placed. If it's at the top of an uptrend, then it's a shooting star. It's supposed to be a star streaking across the night sky, falling to earth, so of course it's a bearish sign. If it's at the bottom of a downtrend, it's an inverted hammer because, well, it looks like a hammer, but upside down. Think about what these candlesticks mean. Remember, it's all about psychology of candlesticks. It's what tells us what's going on. So, you have your colored in candlestick, and it doesn't matter the color. Well, how did this day play out? You can see that the sellers came in, but the buyers came in in a strong move to the upside, but eventually failed. So think about all of the people that are trapped in this trade along this wick. They're in trouble if price goes against them. So at the top of a uptrend, you can see that we have rallied and then failed to confirm the rally. And once we break down below the bottom of the stick, everybody here is losing. So of course they have to turn around and sell their stock to close out their position, so it becomes a bit self-fulfilling. You know, if you're trading a day that looks like this and you say you buy here and things look really good for most of the day and suddenly you're losing money, and the next day you wake up and you're losing money even in a quicker manner, you're going to get upset and you're going to get out of the market. So that's how the shooting star works. Now the inverted hammer, kind of the same thing, but ironically, the exact opposite. And what I mean by that is, same candlestick pattern, but it's at the bottom of a downtrend. So what you're seeing here is, sellers are coming in and they're pushing prices lower. Well, what happens if you get in this candlestick, sometime during this day and, it goes against you a little bit, but you close out the day and you feel pretty good. You think, okay, fine, the downtrend's continuing. What does this mean? Well, this can mean a lot of different things. If it breaks down below the bottom, it's a simple continuation. You can see that the buyers had trying to push prices higher, but failed. So that is what you would expect. So this day being in the middle of a move lower might look something like that. And then we drift even further. Okay, that's fine. That's great. But what happens if you have this day, you start shorting, somewhere around here, and it goes against you a little bit, but you're in profit. Well, what happens if the next day looks something like this? This is a positive candlestick. Well, you got a problem, because not only are you losing money, but everybody who shorted that day or the hour, whatever it is now losing money as well. And that's a breach of major resistance. That's an inverted hammer. So think of it this way. In a sense, these are basically dojis, because what you're waiting for is a break in one direction or the other of this massive move. If we break down, it shows bearish pressure. Well, if you're in a downtrend, that's fine. But if you're in an uptrend, that's a problem. If we break above there, it shows bullish pressure. And remember, failed candlesticks can be a signal in and of themselves. At this point, really what you're paying attention to is resistance and support. There's support underneath. There's resistance above. And if the support gets broken, then that's bearish. If the resistance gets broken, that's bullish. It's really how you need to look at this. Just think about the psychology. Think about what the line graph looks like for that hour, day, 5 minutes, whatever. Now, obviously, on higher time frames, these candlesticks mean more. And they also mean more if accompanied by a support and resistance level that matters on the chart. So let's take a look at a couple of examples. Right here, we had a strong move higher. We formed a shooting star, broke below it, and you can see that was the beginning of a move lower. And speaking of failed candlesticks, you can see that this hammer caused a little bit of a rally, but once you break down below that hammer, that's a very negative sign. That's a broken candlestick. That's another broken candlestick. So you can see that we just came back to fill the gap. Now, these are 1 hour candlesticks, but this would be the same daily, 5 minutes, doesn't matter. Here's another shooting star that almost got broken to the upside, but it didn't. So you had a shooting star, first sign of trouble, then this massive bearish candle, another sign of trouble, and we turned things around. Now, as I record this, the Friday session formed on the hourly chart, an inverted hammer, and we have broken above it. That's a pretty bullish sign. That shows that perhaps the downtrend over the last couple of days is ending. Buyers are stepping in, and more importantly, short sellers are covering. I cannot stress this enough. You want to trade with the trend, but you also want to trade at support and resistance, and you want to think about what the players involved in the market are experiencing, because that's ultimately what drives the market. here's a candlestick that is interesting because it's at the bottom of a downtrend. It's not at the very bottom where you really want to see it. But once you gap above this attempt to push this market down, you can see that we went much higher. And why? Well, because everybody who shorted in that candlestick is losing money. Think about people that are trapped and take advantage of it. That's really what trading is. Because you need that momentum. They've got to come in and they've got to panic and get out of their position and push it in your favor. So as you can see, the shooting stars you want at extreme highs or lows, they do happen in the middle, but they don't matter as much, obviously. And the more extended a market gets, the better a shooting star is. So let's go ahead and take a look at the daily chart. There you go. So here's a nice move higher. Shooting star preceded by hammer. We broke through the hammer. That's a failed stick. That's a proven stick. And we broke down somewhat significantly there for a few weeks. And you can see that as time goes by, the shooting star did fire off a signal. Shooting star here after a nice bounce from a hammer. Right at previous support. Excellent sell signal. Shooting star here at a gap, which should offer resistance. Excellent sell signal. This shooting star at this previous support and resistance line again at 245 or so. You can see it repeats itself. On and on and on. Pay attention to these candlesticks. They matter. They matter a lot. So, with your top-down analysis, you recognize that there is an inverted hammer there that has been broken 2 days in a row. But before that, we formed a hammer. Let's go back to the hourly chart. You can see that this inverted hammer has been broken to the upside. So let's go back to the hourly chart. Now that we have this inverted hammer here, it looks like the buyers are really starting to demand a lot here. Around 244. So this move is starting to make sense. It probably has legs up to 229 or 230 or so. It's not a guaranteed move, but it certainly shows that there's resiliency there. That's the type of top-down trading you need to do to be a resilient and successful day trader. This video is going to feature bullish and bearish engulfing candles. So this is a two candlestick pattern. Essentially what you have is you have a candlestick that gets followed by a much bigger candlestick. Whether it's bullish or bearish depends on what the trend had been previously. So, for example, what you're looking at here is one of two things, depending on the colors of the candlesticks. You're really looking at a downtrend, which the next day may have gapped lower and then shot much higher. And think about what that does. That wipes out the sellers from the day before and most of the time a couple days before. If it's a truly large engulfing candlestick, it'll do a lot of damage in a very short amount of time. You know, you gap lower and the market just turns right back around. That scares a lot of people who are short. If we're going long and it ends up being a bearish candlestick, this would be red then. It's a rally. You get a quiet day. You get a gap higher, so everybody's happy because they think it's going to continue. And then all of a sudden something horrible happens to price action and you wipe out several days. There does need to be a gap, though, because the second candle needs to engulf the other one, so it has to be higher and lower than the previous candlestick. On this chart here at Yelp, I've got a couple bullish engulfing candlesticks. You can see that clearly swallows the candlestick before, and so does that. So how do we trade it? Well, the stop loss goes on the other side of the candlestick, because if we were to turn around and wipe out this candlestick, that would be a very negative sign. As far as the entry is concerned, it's just simply a break of the candlestick. And you can see both times it's worked out for nice, profitable trading afterwards. With the bearish candlestick, and this isn't as extreme of an example, but it certainly is a valid one. You can see that we had a couple of candlesticks here that got swallowed by this one. And what I also like about this is that there is a shooting star right here, and then this. So on a break below the bottom of this candlestick, your stop loss is above this candle and you continue to go lower. And these happen enough that You see them quite often on charts. Now, I don't want to say they're common, reasonably common. They're not, I wouldn't call them rare because they do happen. But when you look through daily charts, a lot of times you'll see them pop up and then you look back at the chart and you go, oh yeah, there was a reversal area there. And, in hindsight, it's always 2020. That's the thing about these things. You have to trust the patterns. You have to know that over time they work out. There's a slight one there. This chart here shows quite a few close. Like, for example, this is close, but no cigar. This would be a bullish engulfing candlestick. Not my favorite kind, though, because I really like to see, the more pronounced it is, obviously, the more interesting it is. Because you wanted to catch enough people's attention that the market moves right along with you. There are enough people out there going, hey, this is a sell signal. Like this city one was pretty negative. Your stop loss was up here. You got all the way down to the previous resistance level before it turned back around. You also want to, when you trade these, so this is a perfect example of one that, although it is a nasty bearish engulfing candlestick, you would know that somewhere right here around 70, you're probably going to see some buyers due to the previous resistance. Well, at this point, this is a candlestick that makes you risk $3.90 to pick up two. So that's not a trade. It's doable, but the risk to reward just isn't there. Clearly though, with that volume that probably attracted a lot of people, I suspect that they probably shorted it, took some profits based upon some news or something. But that is an example of looking at just the candlestick and how much trouble it can get you in. This is technically a bearish engulfing candlestick, but look at all of this support just below. So do you really want it to risk a couple bucks to pick up, say, 50 cents? And no, you have to use some common sense. But they are excellent signals when they do happen, especially when you have some room to run. I like them when they show up and at various extremes. So with that being the case, take a look on typically the daily charts. You will get them perhaps on an hourly chart at the open, but this is generally a daily or even weekly signal that people will use to determine the trend. And then if they are shorter term traders, use it as a guideline as to how to enter the markets. In this video, we're going to take a look at the Harami. There are two versions, there's a bullish and the bearish, and the Harami is, Harami is a Japanese word for pregnant woman. And therefore, that's your first hint that this is a two candlestick pattern. And essentially what we're looking at is a candlestick that's a little bit bigger. The first one, that is. Followed by the baby, that's the mother and the baby. You'll notice that there's a gap and a tightening of range. So if it is a bullish Harami, what you'll see is a downtrend. And then on this last day, we'll gap up and we'll just kind of tighten up a little bit. And it shows that perhaps the market, at the very least, is running out of momentum or could be trying to accumulate buyers. And then you get a move higher, and that is a bullish Harami. The bearish one, the exact same opposite is true. We're rallying, we get a continuation candle, and then we get a gap lower, and the market just hangs there. There's no attempt to try to break it out to the upside. So then it becomes bearish once we flip over and roll back on the other side of the hill, as it were. They don't happen all the time, but by their very nature, they tend to happen on daily and higher time frame charts because, of course, you need the gap. So you can't necessarily expect them as an intraday trader. I mean, it's not that you can't get them. It's just that it's extraordinarily rare for that to happen. So here on Verizon, we have a red candle after a nice sell-off, followed by a gap and a tighter and smaller candlestick, and then a break to the upside, and that is a bullish harami. The trigger is once you break the top, or in the case of a bearish one, the bottom of the mother. The stop loss goes on the other side of the candlestick formation, and you just simply manage your trade as per usual. This one makes a lot of sense, to me at least, because you can see we are right here where we had seen support previously. It's a classic signal. No reason to be overly concerned, especially once you break 50, then you get the psychological break and you continue to go much higher. Here in the Qs, we have one at the top of a very stretched out run. You can see that we had been basically parabolic, had been screaming for some type of sell-off. You can see that this level not only mattered here in this bearish harami that kicked off a pretty significant move to the downside, but later on it had been important a couple of times as well. Very interesting how the market repeats. See, nothing's really random when you start looking at it like this. Both of these candlestick patterns were very useful, and they both worked out quite well. You don't see these a lot, and keep in mind that, so here's an example here. Your first instinct might be, well, this is a bullish harami, but this wick went well below the mother candlestick, so it's not a bullish harami. This is actually a hammer, which of course is a very bullish sign. That being said, it did work out, but you have to be careful. You need to make sure that you are completely contained within the mother to be a true harami. In this video, I'm going to take a look at tweezer top and tweezer bottom patterns. These are two candlesticks, and they're one of the most easily identifiable sets of candlesticks, and personally for me has worked out quite well. So a tweezer top is pretty straightforward. It's two candlesticks, and they both have longer wicks on the top, right around the same size. And a tweezer bottom is the same thing, just as I'm sure you guessed, is at the bottom of a downtrend. These are reversal patterns. So the tweezer bottom might look, something like this. And these might be white or green. These might be red or black. They don't necessarily have to be, but most of the time you're going to see at least a 50-50, meaning one of them red, one of them green. So think about what's happening. So I'll go ahead and draw this out. This on a line chart looks like that. And that means that we clearly have resistance at that level. This on a line chart looks like that. It's a representation of an M and a W pattern with two candlesticks. That's exactly what's going on. If these are days or hours or whatever, if you draw a line chart of these two candlesticks, that's what you're getting. People who are buying at this point are struggling to go higher, and they're becoming concerned. People that are selling are struggling to go lower, and the buyers are pushing them back up. So with that in mind, let's take a look at a couple tweezer top and tweezer bottom setups here in the Ripple market on the 15-minute chart. Couple long wicks in a row. That's tweezer top. You prefer to see longer wicks, if at all possible, but that is a tweezer top. How do you short it in this case? You sell it on a break below the two candle pattern. You put the stop above the tweezer tops, and then you let it go. The tweezers, the two candlestick wicks, are your signal themselves. So as I go through this chart, I will find several other examples. I'm sure they're pretty easy to spot. Here's another. Right down below the two candlesticks, it's a shorting pattern. Tweezer bottom on a pullback. You can see that the market could not break down, and we shot much higher. Again, remember that the tweezers you want to be somewhat similar in height. So, for example, these two are pretty close to the same height. These two aren't, and they've got a candlestick between them, so you don't want to be bothered with that. I wouldn't even call these tweezers, although they worked for a selling signal. I wouldn't use that as an example, though, because that's not showing mass exhaustion. You know, the longer the tweezers, the better, quite frankly, because it shows more and more people are losing money trying to go that way. And remember, people will do more to not lose money than they will to gain it. That's a proven hypothesis and theory in psychological research. And it serves quite well in trading. It shows up all the time. As you look at the candlesticks, you can see that there are little ones everywhere. But again, I would implore you to look at ones that are a little bit longer at a run in the opposite direction. I'll go ahead and switch to the 1 hour chart. And you can see there's tweezers there, there's tweezers there, there's tweezers there. Short-term bounce. There are a couple other right there. It's a bullish one. And you can see that it just repeats itself on and on. It's a sign that they can't break down. Now, the question is, what's really going on? And what's really going on is there's an area, in the case of a bottom, of support, and there's an area of resistance. And I want you to look at these candlesticks and be able to extrapolate in your mind what they look like on a line chart, because that's the easiest way to truly identify them. The nice thing about candlesticks, though, is they have little tricks like this where you can say, okay, well, they can't break down below there, and you don't have to think, oh, that's a W pattern. In this case, it's an hourly chart, so like on the 5-minute chart, it might be like that. All that you need to know is that they can't break it down below there. And a lot of times trading is simply about going where the market wants to go, or better yet, not putting money in the direction of where it can't go. So think about that. In this video, how to trade morning and evening star patterns. So these are 3 candlestick patterns, and essentially what you have is a situation where you get a couple of gaps, so 3 days, for example, where you get long candlestick. This would be bullish. This could be bullish or bearish in this example, and this would definitely be bearish. This is what is known as an evening star. It's out, it's nighttime, shows negativity, but you have the gap there and the gap there. The wicks can cross each other. It's just a matter of the gaps being there. Now, a morning star, of course, would be the exact opposite. And you can see that you would have a negative candlestick here. A candlestick here that could be positive or negative. That's the thing. The star itself doesn't really matter, other than it's very small compared to the other candlesticks. Or it shows a lack of momentum, I should say. And then you have a gap above, and it shows a reversal. Now, these candlestick patterns, you have to think about what they show. Well, they show here, in this one, we're in an uptrend, so we're going higher for a while, and on this day, we get a bit of a move, and then we gap higher, and that should be a continuation of the trend, but things don't really take off that day, and then the next day, it gaps down. Well, that's a sign that things could be changing. It's a very bearish signal. You simply put your stop loss on the other side of the 3-bar pattern, and you take a short based upon a break of the 3-bar pattern itself. So the longest candlestick, in this case, it would actually be underneath here. You would start shorting. Causes a little bit wider stops at times, but it's generally thought that you should get a bigger move. Now here in this one, the morning star, the star is going to rise since bullish. You can see that we drop. And then this day, things drop a little further. Then we get a little bit of a gap lower, which should be a continuation, but the market really doesn't move that day. Then the third day, we gap higher. Break above the top of the candlestick pattern, the 3 candlestick pattern, stop loss underneath it, and you swing for a trend change. So here is an example of a morning star. You can see that This candlestick was negative. We closed up here. We gapped lower, but we had a pretty tight range here and then gapped higher. You can see that was, in fact, beginning of a pretty significant move based upon the morning star. You know, your first target would have been the next resistance level, very easily made. This resistance level, and then this resistance level. So certainly you hit all of your targets. Over here in Yum Brands, we have a evening star because we have a long candlestick here at the top of a trend. We have a neutral candlestick after the gap, and then we have a gap lower. So that is an evening star. Some people would even call it a shooting star. But in this case, since there's two gaps, it's technically an evening star. You can see that we fell right to where support would be and then eventually broke down through it. Stop loss would go on the other side of the pattern like I had talked. In this case, you would take a break of the 3 candlestick pattern right there. You had a pretty quick move, about 1.5 times your risk, and then you eventually broke down rather significantly. These are generally only found on daily charts because of the gaps needed, but unless, of course, you're trading a very illiquid stock in a short time frame, then you can see these all over the place, and they don't mean as much. You do need a liquid stock, something that trades decent volume. Both of these, Hyatt and Yum Brands, would certainly fall in that category. In this video, I'm going to take a look at 3 white soldiers and 3 black crows. Now, as I'm sure you can imagine, there's 3 candlesticks in this pattern. I would also point out that the white soldiers are really green soldiers these days. This harkens back to the black and white candlesticks. So think green soldiers, red crows, but you get the idea. It's all the same thing, really. So at this point, I'm drawing these patterns out, and something that I would bring to your attention is the psychology of these patterns because it takes so much to make them occur. This is typically found on the daily chart. That's pretty much what people use to refer to these patterns. And what happens is you get a bullish day, and then the second day you gap lower, but the buyers come in and overwhelm the sellers. And then on the third day we get another gap lower, and the buyers come in and overwhelm the sellers. Well, think about how much momentum building, how much wherewithal that takes by the buying public to push the market higher. 3 black crows, same exact thing. We break down, we get a gap higher, but the sellers come in and overwhelm. And then on the third day we gap higher, but the sellers come in and take over again. Trading these are simple. You put your stop loss on the other side of the 3 candlesticks. Or if you're a little bit more conservative, you can make it the second candlestick. Comes down to you really, your risk profile is. And you're aiming to follow the trend. You're aiming to find, in this case, resistance. Or if you're 3 black crows, you're looking for support. If you don't have that, you know, the reason I don't say 1-to-1 or 2-to-1 is that you're looking for a bigger move at this point with a little bit of luck. So if you don't have support or resistance, then you start looking for candlestick patterns that suggest a reversal, like a shooting star or something like that down the road. So, as always, let's take a look at an example. You can see rally, gap lower, rally, gap lower, rally again. So on a break of this candlestick pattern, stop loss in this case could have gone at either one. And you can see clearly that we've rallied. Where did we run into our first bits of trouble? Here at these shooting stars. So it does work out. And that's an example why I say use your candlestick pattern, because since there was no real clear defined level just above, you want to at least give it the chance to take off. So in this situation, on Zillow, we have negative candle, gap higher, breakdown much lower, negative candle, gap higher, breakdown much lower. So clearly this is a sell signal. And with a bigger spread out pattern like this, you probably could just go ahead and put the stop loss somewhere in the second candlestick. And where do you get your signal to reverse? Well, right here is support. You get an inverted hammer that breaks to the upside. So it did in fact work. These candlesticks though sometimes can lead to massive moves lower. And for that matter, as I record this, it still hasn't hit your stop loss had you decided to write it out. But obviously, this is a downtrend. There was support there, so it would make sense to take advantage of this. These candlestick patterns don't happen that often on the daily chart. So when they do, you really should pay attention. And in fact, I can see a slight gap here. So that technically did work itself out. And you can see that we got a nice run up. We got a hammer back here when you would have gotten in. So that offered support. And really, this shooting star was your first sign of trouble. You probably would have gotten out up here. So that's an even better example of the free white soldiers. Very strong patterns, don't happen all the time, show a continuation and a resiliency that you should pay attention to. In this video, we're going to take a look at bullish and bearish abandoned baby patterns. Now, these are modified in Forex because they need gaps, like some of the other patterns that we've talked about, but they are powerful patterns, so we don't want to ignore them, obviously. And what an abandoned baby is much like a morning or evening star in the sense that it is a 3 candlestick pattern. And to be honest with you, I've always kind of looked at them as the same. So this is a bearish one. You'd be in an uptrend here. You'd have the baby, the abandoned baby, because there are gaps. And in a downtrend, you would have a bullish abandoned baby because you would have the first candlestick would continue the downtrend. Then you would have a gap lower, and then you would have a turnaround. And that would be obviously a very bullish sign because the sellers just couldn't keep it up. And that's essentially what you're looking for. Now, in Forex, we have these wicks that'll come into play. And this is my example here of a bearish one because you have the body of the candle. You have the next body a little higher. Then you have the third body much lower. A break of the third candle is a selling opportunity. We go right to where you would expect support and then turn around. So this isn't a trend changing pattern in this specific instance, but it does show some weakness and it does end up being a profitable trade. Remember, you always have to have an exit point when you place a trade. It was a 1-to-1 target, so nice little counter trend trade. If you take the wicks out, it is the same pattern. We don't get the gap down below. But unfortunately, that's one of the adjustments we need to make. So in that sense, it's traded very much like an evening star would be in Forex that we discussed earlier because of the modifications necessary. Now, in this case, you could make an argument for an abandoned baby in the bullish sense in the Swedish krona because we were negative. We ended up forming the little candle there, and then we rallied. And you can see that we rallied a little bit. And again, this wasn't a complete trend reversal, but this was a pullback. So quite often you'll see that with these candlesticks in the modified Forex version because you have to ignore the wicks. So what does that mean? That doesn't have the same power as gaps do on a daily chart in a stock market, for example. So a lot of times it doesn't mean an impending trend change. It just means, so for example, if you're short and you see this, you may want to tighten your stops up. That's another way to use it. Sometimes when you see a pattern working against you, then you know that once it gets fired, and in this case it would have been at the top of the third candlestick, you have to be a little bit more concerned about your short position and the dollar against the Swedish krona, for example. There are a multitude of ways of using this information. Remember that just because it's a bullish sign doesn't mean that you necessarily have to buy. Sometimes it is an excuse to move your stops up. Something that you should always be aware of, that the market may move against you, obviously. These are a bit difficult to trade in Forex without doing a little bit of research on modifications, but they do happen. The main thing is basically, you want to see some type of an attempt to go higher. You want the body to be above this candlestick here and then a return. And, since you don't get the gap really in Forex, it's going to look like this. But it says the same thing. It says that the buyers have run out of steam. This might have a candlestick wick here and this might have this here and that there and that there. And that there, but it says the same thing. It says that we are rolling over. Higher time frames mean more as per usual, And again, it doesn't necessarily have to mean a trend change. And a lot of time the abandoned baby really doesn't unless it truly has the gaps. And, that would be like on the daily or weekly time frame. And I can't imagine that happening in the Forex world. I couldn't even find an example if I was looking for one. But we do have our modified on, Forex charts that gives us an idea that, I'd say that it's an imminent pullback. Measuring that against the morning star pattern, which has two, long sticks and then the little body there. That to me is a much stronger signal, and it does tend to work out, for a much bigger reversal. So it's probably the weaker of the two patterns, but it is something worth paying attention to.